Morning, Shane. Thanks again for joining us on Blue Notes on the morning of the bank's full year result. A very solid result, looking at all the numbers. Return on equity is up, earnings per share up, capital up, costs are down. Where did you see the strengths in this result?
Exactly what you just said. I mean, I think this is a tremendous progress for the group, and it's really showing that the strategy that we have and the execution focus is delivering, and it's delivering results for customers, but importantly for shareholders. So I think the strength here is, we have said for some time we saw the operating environment going to be much more different than what it has been in the last 20 or 30 years, and we needed to get ready to deal with that. And so we've been transforming our business. We've been reshaping the bank, we've been changing the way we work, and being really focused on execution and speed. And the results, as you mentioned, high return on equity, costs down for the year. First time since 1999, we've actually had absolute costs come down. This is and of course the stronger capital level, let's not forget that that's really important. So we've strengthened the balance sheet at the same time. So I'm really pleased with the pace and the degree of the transformation.
Nevertheless, as you say, this in part is a response to a very challenging environment. So where do you see, maybe weaknesses or areas where you want to focus more in the result?
Sure, I think for the industry, the first thing people are going to focus on at this part of the cycle is revenue growth or the lack thereof. And the reality is it is hard out there. It's a competitive market. We've got our traditional competitors, we've got new competitors. Consumers are really voting with their feet, really, which is good on them, and that's what they should be doing. So revenue growth is a little bit harder to come by. That's why we have been transforming ANZ, getting ready for that. Really making sure that we put our resources, whether they're our intellectual resources, our financial resources, to work where we can make a difference and we can win. And so, tough times, but that's exactly why we're in this transformation phase.
And indeed, in the actual announcement, you talk about 2016 as being the year of reshaping, and this is now the period of execution. Does that mean the reshaping has finished and the concentration is all on execution?
No, I mean, reshaping is going to be a bit of a constant because we live in a fast-changing world. The expectations of the community change fast, the expectations of our customers change fast, and so we constantly have to be changing. What we're trying to build at ANZ is really an agile, flexible approach that allows us to respond to those needs really quickly. But from a technical point of view, if you think about the rebalancing of our capital mix, we're more than halfway through that. That's certainly true. We've kind of broken the back of it. But it's not a skill we want to forget. We don't want that skill to atrophy away. We need to keep reinvesting and making sure we're constantly reshaping and responding to market conditions.
And one of the measures of the achievement is return on equity. Another is earnings per share, which is particularly strong. Is EPS a big focus now?
Yes. You may have noticed we've talked about it a little bit more in this result than perhaps in the past. And that's really a reflection of us being out and listening to our shareholders, particularly retail shareholders. It's something that they really focus on as a measure of success. And so, yes, we talk about, and I understand it, it's a great indicator of real value creation for shareholders. So, yes, we are focused on making sure, because it reflects not only good earnings story, but also good capital management, making sure we don't have too many shares out there on issue.
And indeed, capital has been a very strong focus for the industry and indeed for regulators since the financial crisis. In Australia, the Murray inquiry said banks had to be unquestionably strong. Is ANZ now unquestionably strong from that perspective?
Yes, and one of the big things we've had as an industry this year was APRA giving kind of a unqualified definition of what that is from a capital perspective, saying it's 10.5% on a common equity tier 1 basis, and the industry has to be there at the beginning of 2020. And the good news for ANZ and for our shareholders is actually, as you see in this result, we're already there. So we're there 2 years ahead of schedule, so we're very, very well capitalised. And why is that important? Because it gives us more options about the future than perhaps some of our peer group.
And as shareholders, and I'm a shareholder, we always want more. You talk about capital management. Does that mean capital back to shareholders at some point?
Yes, essentially. I mean, what we're talking about here is we've got to run the bank prudently. We've got to have, sufficient capital, not just to meet the regulators' requirements, but what we think the right amount of capital has, and we've got to get that right. But because of our strategy, because of the rebalancing, we are freeing up capital. So as we sell things, we get the funds. And so what we've said is there's no real incentive for us to sit on lazy capital. So when we do get those proceeds, and we haven't really received that money from any of those sales just yet, when we do, we would be in a position to consider returning that to shareholders. And that's usually through, maybe through a buyback or something like that.
In your outlook, you talked about being optimistic but still cautious given what's happening geopolitically and around the world. And you raised the issue of household indebtedness as a particular area of concern. But you seem much more sanguine about the risk in the mortgage book than, say, APRA, the regulator, is.
I don't know that we're more sanguine. I mean, it's a big exposure for any bank, so we watch it like a hawk. I mean, it's something we look at the data literally on a daily basis to try and understand. It's in our interest to make sure that our customers borrow responsibly, and so we do look at that. Household debt levels are high. They're higher than they have been in both Australia and New Zealand, and they're reasonably high on an international basis. There's some good reasons why that's okay, but we don't want to be complacent about it. So, I think we get paid to be cautious and to be prudent. That's the nature of banking. And
the return on equity was another very strong story, but in your comments, you mentioned it may have well been 3 percentage points higher had it not been for recent waves of regulatory impost and taxes and things. So that's 300 basis points off your capital. Is that a sort of one-off, or do you think those sorts of discounts are continuing to apply?
So what we said there is, if we just look at the impact of the changing in regulation and taxes over the last 2 years, so that's a period where APRA has required us to have more capital, to hold more liquidity, and of course we had the imposition of this, the Australian bank tax. Those three combined, all else being equal, would mean that the ROE of the industry would drop about 3%. That's a big number. Now the good news is that ANZ was ahead of the game. Part of our reshaping, getting ourselves kind of match fit, has been to help mitigate some of those pressures. I imagine that those things will continue to put pressure on our industry, but not to the same magnitude again. I think again we're way past the middle of that, but that's why we have to be match fit. That's why we have to be lean. That's why we really have to be on top of our game.
And one thing that you did announce at the half-year profit was a new agile way of working, particularly for the Australian bank. And that's part, obviously, of the cost drive, the efficiency drive, the agility drive. How is that program progressing?
Well, it's a really important program. And why? It goes back to where we talked about before, this need, essentially the need for speed. We need to be out there responding to our customers' expectations, community expectations, at pace. And so that puts it, we have to think about the way we organise ourselves, the way we work, to enable that. And that's what this agile way of working is about. We kicked it off early in the year. We've done a lot of planning. It's really quite exciting to be in that division at the moment. There's a lot of buzz. There's lots of excitement about what the future holds. Early in 2018, we will be moving to this way of working. So we're at the end of the planning phase. We're appointing people into jobs. And it's going to be a really terrific differentiator for ANZ, and I know our customers will notice and get the benefit, and our people will as well.
Well, thanks very much again for speaking with us, Shane.
Thank you.